All right, what's up, family? So this is pretty much just going to be exactly what it says, the intro to Wyckoff methodology. And we're really going to be looking to break this down so you can really get a proper understanding of it. So our itinerary for today, ultimately, we're going to be going over the three fundamental laws. We're going to cover all the types of schematics, and then we're going to go over pretty much like the three types of schematics that we actually focus on. We're going to go over the number of schematics, the actual events and phases. We're going to go over where to actually identify these schematics and our confirmations for them. Then we're actually going to go over how to pretty much identify ahead of time, 100%, how to 100% identify ahead of time, how to identify a schematic. We're going to identify some failed schematics and understand the confirmations for our failed schematics. And then we're going to end off the call just going over some indicators, and then kind of like my top-down analysis. And then I actually have maybe like 2 to 4 schematics that we've caught this week that I could just share with you guys. I believe like 3 of them are type 1s, one's a type 2, and yeah, we'll check them out. So now these are our fundamental laws. Now, these are extremely important. So number 1 is going to be the law of supply and demand, which this is relatively like simple. Everybody kind of knows of supply and demand. And just to keep it simpler, pretty much when demand is greater than supply, we should go up. And when supply is greater than demand, we should drop. So that's the basics behind that law. Supply and demand, you could definitely do a lot more research on it. Our next law that we have is going to be the law of cause and effect. And this law is actually really cool. So now what cause is always going to be our sideways movement or our consolidation. And our effect is always going to be the expansion markup or the markdown. So the reason why this is important is when understanding a schematic, we're going sideways. So the law of cause and effect states that if the cause is greater, the effect is going to be greater. If the cause is lesser, the effect will be lesser. Does that make sense? So ultimately, the bigger the cause, the bigger the effect. And then last but not least, our third law is going to be the law of effort and result. And this is one of the reasons why we pay so much attention to the volume, just in any type of like foreign exchange market or any type of financial market, but it's simply due to the fact that these big operators, they have so much money. They have literally, I'm not even going to put a number on it, but with that being said, they cannot come into the market and say, okay, I want to buy gold or EU, whatever the case may be, because for every single buyer, there has to be a seller. So with that being said, with them trying to come into the markets with these big amounts of currency, they're going to drive the volume up. So when we see the volume go up, when we see a lot of volume, that's typically meaning that we have a lot of effort. So more effort, more of a result. And pretty much price is our result. So if we see a lot of effort as far as volume, we're going to see price move a lot. If not, we might not see price not move a lot. So that's the 3 laws. That's the 3 laws: law of supply and demand, cause and effect, and effort and result. Boom. All right, so now types of schematics. So this is going to be really important to understand. There's 8 types of accumulation, and there's 7 types of distribution. So now online, you're really only going to find 1 and 2. You might get lucky and find maybe 4, maybe 3, but these are really hard to find, and not too many places just giving out this type of information. A lot of people pay tens of thousands of dollars for Wyckoff courses. So yeah, with that being said, you're really not just going to be able to look it up and find them, but keep in mind, it really doesn't matter like the type doesn't matter, because when we understand what event what event should actually accomplish, it's going to be easy to know, okay, we're inside of a accumulation, or we're inside of a distribution based off of just what our events are doing. So now the types of schematics that we actually focus on, they're typically just our type 1s, our type 2s, and occasionally we do get a type 4. And the reason why we have our type 4 in here is because the type 4, in my opinion, is the most like drastically different schematic than any of the other types, due to how it actually is shaped. And we're going to go through it. So now, along with all of those schematics, accumulation and distribution, we do have 4 types of reaccumulation, and we have 4 types of redistribution. Now, the types of reaccumulation and redistribution don't necessarily matter. You guys will have access to this in the Wyckoff course, but pretty much what we're going to go through today is just like what we look for to identify reaccumulation or redistribution as well. Perfect. So now our type 1 schematics. In our type 1 schematics, we're always going to have either a spring or a UTAD. And ultimately what this is doing, this is testing the minimums or the maximums of phase A and B. So ultimately we want to see it take liquidity. So if we have relatively equal lows, even every single low, every single high has liquidity. So if we see price take the liquidity from phase A and phase B, this is going to be our spring. Once we break structure, that confirms our entry. Relatively simple. So now, as we're switching over to our distribution right here, same thing. So ultimately, all we're looking for is our UTAD to break the maximums of our phase A and phase B. And then once we get that break of structure, we will be able to catch an entry off of our UTAD. So let's actually get into the phases. Let's get into some of the events so you guys can actually get a proper understanding of what should we be looking for. So pretty much in our phase A, this is always going to be our phase that's stopping the previous trend. So in accumulation, we're stopping the previous bearish trend. In distribution, we're stopping the previous bullish trend. And that's all phase A is pretty much supposed to accomplish. So in phase A, we're going to have a couple events. Our first event is going to be our preliminary support or our preliminary supply. So our preliminary support, think about it like this. Let's say we're coming to a stop sign and the stop sign is right here. As we're coming to that stop sign, are you going to just stop right when you get to that stop sign? Probably not. What I'm probably going to do is I'm going to be going, I'm going to slow down a little bit, keep going, slow down a little bit, keep going, slow down a little bit. So ultimately, this is just the institution slowing down before they get to their stop sign. That's all a preliminary support or a preliminary supply is. Really simple. And from here, ultimately, we're looking for price to then create a climax. So our climax is pretty much our last preliminary support. Our buying climax here is our last preliminary supply. That's all that it is. Like, that's all that it is just the last one. And what confirms it as the climax is the movement away. So this movement away, the label is to our automatic rally. And then when in our distribution, this stands for automatic reaction. So once we have this AR, this actually confirms our SC as our SC and our buying climax as our buying climax. Now, how this confirms it is based off of something we call a change of character. So our change of character is nothing more than exactly what it sounds like. It's price showing that we want to change from a trending environment to a consolidation environment. That's what we expect from our first change of character. So we were just trending and our change of character is letting us know, okay, we're going to get a change of character. It's going to start consolidating. So from our change of character, we're really just looking for a deeper retracement than our last couple of retracements. So if we were to really kind of like figure out how to do this, what we would do is we just measure our retracement. So I'll get my Fibonacci, measure from here, my swing low to my swing high, see how deep a retracement this was. Measure from my swing low to my swing high, see how deep a retracement this was. If this is a lot deeper than my last one, this is going to be my AR, my buying climax of my AR, because this is my change of character. Did that make sense? How we identify our change of character. Ultimately, we're just looking for a deeper retracement, a bigger retracement than the last couple of retracements. That's all. So once we've identified our climax, our AR, our climax, our AR, we should then confirm our AR by having a secondary test. And ultimately, in accumulation, our secondary test is just going to be testing demand of our climax. And in distribution, our secondary test is going to be testing supply of our climax. Now, this can test inside the candle, or it could test above it or below it. As long as we're getting a test of some type of demand or supply, and then having a reaction away. That reaction away is actually extremely important. That will confirm this as our secondary test. So now, once we have our secondary test, we look to push up and hopefully create an upthrust action, or we create a minor sign of weakness. So now pretty much our upthrust action is going to be exactly what it sounds like. It's an action that thrusts the tops, the maximums of the trading range, and immediately comes back. We don't want this to chill up here, hang out all day and then drop back. That's not going to be our upthrust action. We want to see price spike up and spike back into the trading range. And same thing for our minor sign of weakness. We don't want to see price just chill down here all day, negative. Ultimately, what we want to see is price spike down, test the minimums, and spike back into the trading range. And that would confirm our upthrust action. Ultimately, our upthrust action is pretty much like our minor sign of strength. That's our first sign that price actually wants to go higher. And same thing for our minor sign of weakness. So after these actions, we then get another secondary test. Our upthrust is technically a secondary test. Our SCMB is a secondary test. What confirms this as our secondary test in phase B is going to be one of two things. In a type 1 accumulation, what confirms it is pretty much us trading back inside our trading range, trading bare minimum 50%, and then trading down and getting our spring. That's our confirmation for our SCMB. We have to obviously test something. We want to test some type of demand. A lot of times we would like our secondary test in phase B to test the minimums of the trading range. And if we could do that, we would like to trade at least back to 50% of the trading range and then get a spring. And that would confirm our SCMB as our SCMB. So now same thing. So let's say we're looking at price as it's up here. I would be looking at this as just being a secondary test until we trade to 50% and then get our UTAD. So once we trade to 50% and get our UTAD, that confirms, okay, this is my upthrust, which is technically our STM phase B. And we just have to wait for our confirmations, which is going to be our break of structure from the upthrust. So SCMB and upthrust are literally the same thing, just flipped upside down. Our confirmations formed, we needed to trade to 50% and then give us our spring or UTAD. So now once we get that spring, what we're expecting for this spring to accomplish, this is extremely important. We want the spring to take out all the buyers. So there's buyers that got in right here. There's buyers that got in right there. There's buyers that got in right there. And our spring is taking out all of their stop losses. And then we're enticing sellers. We're enticing breakout sellers to start selling. And then we're taking all their stop losses. So pretty much, ultimately, let me repeat that. They're taking out buyers, enticing sellers, and taking out sellers. And once we get that break of structure, that's our confirmation for our entry. And we enter off of the test of the spring. And we look up to get a sign of strength. From our sign of strength, we expect a last point of support. And a lot of times from our last point of support, we can start looking for schematics in phase D and phase E. So after an accumulation, we can look for a reaccumulation typically at the end of phase D or at the start of phase E to continue taking it up. And vice versa. Once we trade from our up thrust to 50%, and then we get our UTAD, all we need to do, we understand our UTAD is supposed to accomplish taking out sellers. We have sellers here, we have sellers here, we have sellers here. We want to take out our sellers and then entice our breakout buyers and take out the buyers. Once we break structure, that's our confirmation for our entry. We enter off of the test of the UTAD and continue taking it lower. And same thing in phase D and E, we can start looking for signs of redistribution to continue taking this lower. So those are pretty much our events. I know I haven't gone through the phases, so let's go through the phases really quick. We have phase A, which is ultimately stopping the previous trend. Phase B is ultimately the institutions constructing a cause. So that's building pretty much exactly like we said, the laws, that's them going sideways. Phase C is going to be our test phase. Phase D is going to be our trend within the range. So we're trending, but we're still inside the range. And then phase E is our trend outside of the range. So those are our phases, and those go for both accumulation and distribution. That makes sense? This is recorded, so you guys can always rewind and go back through all of that. But ultimately, that's what we're expecting from our schematics. Really understand you don't have to have a perfect, sorry. We don't have to have a perfect schematic. Sometimes they're going to be, they're not going to look like this. But all that matters is if you understand what your event should accomplish and they accomplish those events, then yeah, pull the trigger. Pull the trigger. So that is our type 1. Now our type 2 is going to be a little different. So keep in mind our type 1 has a spring or a UTAD, and that takes out the liquidity from phase A and B. Phase 2, we do not have a spring or a UTAD. Our last secondary test is confirmed as our secondary test in phase B or our up thrust when we get our sign of strength or major sign of weakness. So in our type 2 schematics, we do not have a spring. All we have is our secondary test in phase B, or we have our up thrust, which is ultimately still a secondary test. It's just in the phase B. So looking at this schematic, it's the same thing. We have our preliminary support that's trying to stop the previous trend. We have our climax, which is the last preliminary support that causes a deeper retracement with our AR. So that's how we get our change of character. Our secondary test tests our climax, and then we push up and we have an up thrust action. From here, price does trade down and give us a secondary test in phase B, which is just our secondary test until price pushes up, breaks structure, and trades outside of our trading range and gives us a sign of strength. Once we get this sign of strength, that confirms our type 2 schematic, and that allows us to look inside our STMB for entries. We catch our entry at our LPS, our last point of support, and we walk price up. So now for a type 2 distribution, we have our buying climax to our AR, which gives us our change of character. We have our secondary test testing supply from our climax. We have our first minor sign of weakness. And then from our minor sign of weakness, we push up to our secondary test in phase B, which is our up thrust in distribution. From here, we need one of two things to happen. In a type 1, we would want price to trade to 50% and then give us our UTAD. But keep in mind, this is a type 2. So in our type 2, what we're looking for is a break of structure and exit of our trading range, giving us a minor sign of weakness. Once we have that, sorry, not a minor, a major sign of weakness, giving us that major sign of weakness. Once we have that major sign of weakness, that confirms we can look for an entry off of our up thrust. We catch our LPSY entry, our last point of supply, and walk price down. So the difference between a type 1 and a type 2 is in a type 1, there's a spring or a UTAD. In a type 2, there's not. Super simple. So now going to the next schematic that we look for, it is a type 4 schematic. And the reason why we only focus on these 3 schematics is because they kind of pretty much all look similar. All the events do similar things, but the type 4 is really the craziest looking. And you guys can see just from looking at the picture right now, look at the type 4. We understand schematics are consolidation sideways, but we have, yeah, this is consolidation, but it's going down. We have wedges. So this is why we really like to really inform you guys about the type 4s as well. Pretty much we can have a spring or a UTAD, or we could just have an STMB or an up thrust. Keep in mind all that like if we have a spring or a UTAD, all we need is our break of structure. If we have an STMB or up thrust, we need our sign of strength or major sign of weakness. That's all that means. So we're just going to be looking for those confirmations. And ultimately, the type 4 is just an ascending or descending wedge. That's all the type 4 is. So looking at our type 4 accumulation, we have our preliminary support. We have our seller's climax to our AR. That gives us our change of character. We then have a secondary test, and we can have multiple secondary tests. So we have 1, 2, 3. Price could just go secondary test, secondary test, secondary test, secondary test, secondary test, secondary test, and then make a spring if it wants to. So we can have as many secondary tests as we want. Just keep that in mind. All that we're going to look for is price to give us a spring. And then the secondary test before the spring is our SCMB. So once we get our spring, we identify, okay, this is our spring. Okay, this is my SCMB. All these are just STs. Once we get that break of structure, I can catch an entry off the spring. If this is a type 1. Well, if this has a spring, it's a type 4, but if it has a spring. So now in the type 4 distribution, we have our climax to our AR. We have multiple secondary tests that form this ascending wedge. Then we get our UTAD, which lets us know, okay, the secondary test before the UTAD is going to be our up thrust. Once we break structure, we can catch our test entry off of the UTAD and continue taking it lower. So that's the type 4. Ultimately, our type 4 is just a wedge. So type 1s, we're looking for a spring. Type 2, we're looking for no spring. Type 4, we're looking for a wedge. And those are really the 3 schematics I really focus on myself. So now, where do we want to look for schematics? First things first is we're always looking for schematics in higher time frame point of interest. So let's say we have a sell to buy scenario. We have a sell candle and then a buy candle. And price is currently chilling up here. Ultimately, we understand that institutions have to come back and mitigate out of their position. So keep in mind, if they're mitigating out of their position and opening more buys, what they're going to be doing is getting their orders filled. So price is going to first have to drop down here. We're going to wait for price to come in here, build the schematic. Once we break structure, that lets us know, okay, the institutions, they have all their orders filled, they're ready to take off. We identify the smaller time frame point of interest and catch it from there. So we're always looking for schematics in our higher time frame point of interest. That's first things first. If we're not in a higher time frame point of interest, I'm kind of a little iffy about the schematics. So now number two, we're always looking for schematics, paying attention to the price cycle. And a price cycle is relatively simple. We understand if we're oversold, that means the demand is greater than the supply, and we should look to accumulate. In our markups, we should look to reaccumulate. And then when we're overbought, supply is greater than demand, we should look to distribute. And as we're marking down, we should look to continue to redistribute. So really understanding the price cycle is really going to let you know, okay, where can I look for this certain schematic? And then like the last thing is really understanding we can look for schematics in higher time frame schematics. So let's say this is higher time frame, we're on a weekly, and this is an accumulation schematic. Realistically, at all of these lows, if we're in a higher time frame accumulation, we're going to want to look for accumulation here. We're going to want to look for accumulation here on the smaller time frame, of course. If we're in a markup phase and we see we're reaccumulating, we're going to want to look for some accumulation here. If we're in distribution, we're going to want to catch lower time frame distribution, lower time frame distribution, lower time frame distribution if we can. So ultimately, this is how we look at higher time frame schematics and find lower time frame schematics inside of them. Perfect. So now our confirmations. Ultimately, for a type 1 schematic, all we need is our breakup structure. That's literally our key confirmation. That's 100% all we need. And once we have that breakup structure, we can identify our point of interest, throw our limits on the open and or the 50%, occasionally the 80%, if it lines up, if we have that confluence. So now any other type of schematic, we need our breakup structure and our sign of strength, our exit of the trading range. We need to have no doubt in our mind that buyers are in control. Or if it's distribution, we need our major sign of weakness. We need to have no doubt in our mind that sellers are in control. And then lastly, our 3 key events. So let's say this is really something I got from Ruben Villahermosa. He's the author of Wyckoff methodologies, and he let us know that we really shouldn't focus on the events. Phase A isn't necessarily as important as the rest of the schematic. So the 3 events he focuses on, and really I've trained my eyes to focus on, is very one, our spring. Very first thing is our spring. So if we can get a spring, that is perfect. If we get that UTAD, that's amazing. After that, we're looking for our sign of strength or our major sign of weakness. These are our 2 events that we really need. Once we have this, we're either expecting our backup against the edge of the creek, or we're identifying our point of interest inside of our spring and taking a limit off of it. So our confirmations. So these are our 3 key events. We're looking at our spring, we need that sign of strength, and then we're either taking our entry or we're getting that back up against the edge of the creek, and we're going to get some type of reaccumulation. So those are our confirmations. Now, failed schematics. So reaccumulation is ultimately just a distribution that failed. I really don't mark up the events, even though like sometimes we will actually go through, mark up all the events, all the phases and stuff like that. But really, we're really just going to focus on 2 confirmations. And those confirmations in a reaccumulation is going to be the jump across the creek and our breakup structure. If you can identify those 2 things, you can identify any reaccumulation, no matter if it's type 1 or type 4. So now for redistribution, it's the same exact thing, but opposite. A redistribution is an accumulation that failed. And once again, I don't mark up the events, even though we definitely can and we will. My focus is really just looking for the 2 confirmations, and those confirmations are a break of the ice and a break of structure. Once we identify those two confirmations, it's fair game. We've already identified our redistribution or reaccumulation. So now pretty much we already understand our reaccumulation has a creek, our redistribution has an ice. When I was making these, I made the reaccumulation accidentally have an ice. So just keep in mind, this is a creek, this is a creek. So we understand a reaccumulation, it is a failed distribution. So we're typically gonna get a buying climax, up thrust, UTAD, price is gonna walk itself down, give us our shakeout, which this is our major sign of weakness, that is confirmed as our shakeout once we jump across our creek and break structure. Once we do that, that confirms this as reaccumulation. And that lets us know, okay, so we now can start buying from our shakeout. We can look at a point of interest down here in our shakeout to see if price wants to come back and continue going up. Now for our redistribution, it starts off as an accumulation. We have our seller's climax, secondary test phase B, we have our spring, our break of structure, we have our entry, price walks itself up, builds an ice. This is our sign of strength. That is confirmed as our shakeout once we break our ice and break structure. Once we do both of those things, that confirms this up here as our shakeout, and we can start looking for entries inside of our shakeout to continue taking it lower. Perfect. So now how to identify ahead of time. So this is something I'm always being asked. How do I identify? How do I know? In all reality, you can anticipate it, but there is 100% no way to actually know in all reality. And the reason why is because accumulation can turn into redistribution, and distribution can turn into reaccumulation. So really, all we do, we pay attention to where we are in the price cycle, and we trade what we see until we're proven wrong. It's really that simple. Um, and the cool part about it is we can actually be wrong most of the time and still be extremely profitable due to the fact that we're catching 1 to 20s, 1 to 50s, 1 to 100s, relatively almost every single week. So that's really the cool part about that. Last but not least, sorry. Key indicators. So the indicators that I use, first and foremost is going to be volume. And we use this to really measure the effort and the result. Next, we use our RSI. Now, this is pretty much for divergence, which we actually do use comparative divergence as well. So that's a whole nother lecture. And then last but not least, we have our sessions. And this is just important because price and time are extremely important together. So we want to make sure we're utilizing both of them. So now this is last but not least before we actually jump onto some charts. Pretty much our top-down analysis, it's relatively simple and super repetitive. We just start off on the monthly. I'm always starting off the highest time frame, and I'm doing this in this order. I'm looking for a structure. I'm looking for my trading range. I'm looking for schematics, identifying liquidity and imbalances. I'm looking for my point of interest so I can take trades off of. And then I'm literally waiting for price to get to there so I could look for lower time frame schematics inside of them. Once I knock that out, we do this on every single time frame, working our way down. So we knock it on the monthly, we go to the weekly, we go to the daily, go to the 4, and we go to the 1 hour. And I typically stop around the 4 or the 1 hour. So now once we've identified our bias and the POI we'd like to enter from, pretty much we just have to wait for price to get to our lower time frame point of interest, or we have to wait for price to get in our point of interest, and then we'll go to the lower time frame and wait for our schematic inside of that point of interest. So the lower time frames we typically go to would be like 45-minute, 40-minute, 30-minute, 25, 20-minute, 15, and then all literally the 10 through the 1 minute. We use all of these time frames relatively almost every day, and pretty much we always require a schematic inside of our point of interest that causes the breakup structure. So let's go through this. Let's say we have a high, come down to a low, we push up, we push down, and then push up. So we understand off of higher time frame, our range would be from here to here. This is our leg. Off of a lower time frame, yeah, you could say this is our range. But now looking at this, we understand, okay, what actually caused the break of structure? If this is our high, this here is what caused price to break. So this is our break of structure point of interest. That's what that is. And this point of interest down beneath it is our extreme point of interest. So inside of our point of interest that decides to break structure, we need a schematic to play out. Or personally, I need a schematic. If it gives that schematic, I'll catch my entry and continue taking it up. If not, if it doesn't give no schematic, my limit's down here off the extreme to continue taking it up, because one of two things is going to happen. It's going to stop us out extremely quick, and that's going to let us know, okay, we are now going to be going bearish, or it's going to tap us in and it's going to fly. And I could really just say, like, start journaling and ask your trading journal how extremes are. And yeah, because since I've started journaling and really being able to see, like, when I place my limits on my extremes, it's insane sometimes, the type of risk rewards we catch and stuff like that. But yeah, so that's our top down analysis. Ultimately, we understand we just really want to start at the highest point and work our way down. We cannot place limits on all point of interest because that's just going to be us being trigger happy. We need schematics in some of them, and then in some of them we can place our limits. And just some tips that I have, pretty much schematics happen every day, so really don't force anything. A little quote that I've always heard is, if it ain't clean, change your screen. And really, like, what this comes from is, like, think about when you were a kid and, like, let's say you're doing art projects for your mom or something like that. If you were to bring that art project to your mom and it looked like you just gave no effort, it was sloppy, it was ugly, your mom's probably not going to put that on the refrigerator. She's probably going to slide it inside the little drawer to the side of the refrigerator and kind of just leave it inside there. But on the other side, if you put in a bunch of effort, it looks like you spent a lot of time. It's clean, it's colorful, it's beautiful, and you present this to your mom. She's going to feel so, like, amazing by it. She has no choice but to place it on the refrigerator. So what I really tell myself is, look for those type of schematics. If it's not extremely beautiful, if I wouldn't give it to my mother, then change your screen. So now keep in mind, schematics take time. So a 5-minute schematic can take up to 4 hours sometimes. So really just wait for all your confirmations. Don't rush anything. Something else that I really like, I'm always coming across, is people trying to match the exact, like, their chart to the exact picture, and understand it's never going to be exact. We just want to really get a thorough understanding of the actual events and phases. Nice. So now the last two, we want to make sure you guys are reading Wyckoff Methodologies in Depth by Ruben Villahermosa. This is really where I've gotten most of my knowledge, a lot of breakthroughs. Yeah, he has a huge amount of knowledge inside that book. And then keep in mind, the more back testing you do, the more you'll train your eyes. The more journaling you do, the more you'll actually grow. So those are just a couple tips, family. Those are just a couple tips. This is the end of the PowerPoint. That's the end. And yeah, so let's look through a couple schematics. First things first, let's look at EG. This was a nice schematic this week. So this is a type 1. This is a type 1, and we caught a nice sniper entry off of the 50% of the 8-minute of an 8-minute point of interest. But you could see here, I actually took a light L at first, and I actually just broke even on this. But let's walk through it. Let's really walk through why I looked at it like I did. So if we're looking at this schematic now, we could really walk through and we could see it kind of matches up with the pictures that we have, except for we have multiple secondary tests. So we have SC, SC, ST, and then this last SC was confirmed to me as my ST in phase B once we pushed up and got this sign of strength. This was a sign of strength in my eyes. And once we got that sign of strength, I identified this 8-minute and I took an entry off of the open and the 50%. From here, we could see price does work its way down, taps directly into that 50%, taps directly into that open, obviously, and makes its way. Boom. So let's look at what happened. From here, we pushed up. I believe the top entry was about almost a 3-to-1, almost a 3-to-1. It was actually right here, this wick. So we tapped in right here. We pushed up, maxed out at about 12 pips. We are only risking 5 pips. So that was not yet a 3-to-1. It was close, but the lower entry was definitely a nicer risk reward. Ultimately, we broke even. We placed our trades break even based off of the reaction we got, and price came right back and gave us our spring. So once we got our spring, it's really just understanding, okay, can we make a high? If we push and make a new high, wait. I pull that back. What do we need for our spring? For our type ones, all we need is a break of structure. That's really all we need. So I'm really just looking for internal structure to be broken for our spring. So we understand we break above here. We even break above here. So it looks like relatively equal highs. So yeah, so pretty much we break above internal liquidity, internal structure. And once we do that, it's really just scaling down, finding our point of interest with the most volume. The 10-minute looks fine. The 10-minute definitely looked fine, but the 8-minute is actually what we took. So we took the open of the 8-minute and 50%. And we could see if we just let this play out. We have our break of structure. We identified our spring. We got tapped into our first position right there, and price taps into the 50 and kind of just goes crazy from here. We push to make a new high. We're risk free. We've taken partials, and yeah, the market's closed. This was literally Friday. This was today. So at 2 a.m., this tapped us in and went crazy. We maxed out at about a 13-to-1. So not too crazy of a risk reward, but a nice little way to make some money in your sleep. So to recap, we thought this was going to be a type 2 because we got our sign of strength. Price came and gave us a spring. We weren't discouraged. We understand, okay, we took the L, but price literally came back and broke internal structure. So I'm gonna just give this another shot. We took the entry off the spring and we go crazy. So now for NAS is literally the same thing. We have a bunch of type 1s this week. Ultimately, we have our climax to our AR. This will always give us our change of character because this is a deeper retracement than the last couple retracements. We then get our secondary test. We push down and we do test some type of demand and we trade away. So this is our secondary test in phase B. Then we trade down to our spring. From our spring, we decide to push up, and it was really just identifying a point of interest inside here. And I believe, if I'm not mistaken, let's see, I believe it was at 30. So we took it off of this 30-minute. The open would have been way too big of a stop loss, so we only took 50%. And of course, we added our spread, so we made sure we got tapped in. And this was a relatively cool trade. It wasn't anything too crazy. Nothing too crazy. We did push up to about a 1-to-10. And we could see from here, what we ended up doing is we left a couple point of interest. So we have this point of interest as not mitigated. I'm looking at this as my extreme, and I'm looking at this as causing a new high. So if we build a schematic right here, I'd pull the trigger. If not, I'm looking for a limit down inside here. And that is NAS. We do have GU. So GU, this didn't give us an entry off of the schematic, but where we did get an entry from was an extreme. So we come back, there's a 1 minute extreme up inside here. There's a 1 minute extreme. This is our entry, this black line, and our red line up here is our stop loss. So scaling down into there, let's go to like the 5 minute, perfect. We could see as we get up to this point of interest, we start to build a schematic. Keep in mind that point of interest is the black line. We get our buying climax to our AR. We get a secondary test right here, a secondary test again. We do get our minor sign of weakness. And then we push up and we get our up thrust. That actually taps us into this trade. From this up thrust, we then trade out, we exit our trading range, we get our major sign of weakness, but we never come back. We never come back, our major sign of weakness. And yeah, we just take off from here. So that was pretty much just to show you, we don't always get filled. This was a type 2 schematic that can eventually come back in the future. So this is something to definitely keep an eye on. And last but not least, family, last but not least, let's look at silver. So I had all my charts delete this week, so this is why some of them aren't marked up. But we can identify, we have a trading range. So if this is our trading range, this is our predefined trading range from our AR to, from our seller's climax to our AR, this actually also defines our change of character, and we can start labeling. So we have our climax, we have our AR, we have a secondary test, we have a secondary test in phase B that trades back to 50%, and then we have our spring. From our spring, we don't just break internal structure, we break all of this structure. And we get our sign of strength. SOS. So once we get that sign of strength, it's relatively simple. Okay, let's literally scale back. We tell ourselves, okay, so there's 2 point of interest we're going to be looking at. We have the candle that actually decided to break structure is right here. This decided to break above here. And then we have our extreme. So we would need a schematic here, or we're taking our limit. And where we took our limit is off of this 15 minute, be 50% of it, 50% of this 15. And if we just let price walk itself down, we tap in and we do our Dougie. We do leave a little schematic right here, which is why we're now looking for an entry from here. And just to show you what we're at right now. So we pushed and we made a new high. Once we made this new high, we understood this was our extreme that led to this high. This was our point of interest that decided to break above this structure. So if we would have built a schematic inside this purple box, we would have pulled the trigger. Since we didn't, I actually have a limit down here off of the 50%. So we'll see how this runs. Just to the high, it'll be a bare minimum of like 12-1. So yeah, that's some schematics, family. Let me know if you guys have any questions. Make sure you guys are definitely taking advantage of this Discord as well. Not this Discord, oh my gosh, of this Google Drive. But yeah, family, that's everything. The course will be coming out relatively soon, and I hope you guys find some value from this. Have a blessed day.